Should we call this bellying up with brats? Because we're at the bar.
Hi, I'm Tim Bratz, and every week I sit down with the top influential entrepreneurs in the country to discuss how to leave a true legacy in all things happiness, health, wealth, and wisdom. This is the Legacy Podcast.
Let's talk about finding deals. You've transacted over 6,000 apartment units. I don't know how many deals that equates out to, but what do you know now that you wish you would have known before you did your first deal? What systems or things do you wish you would have had in place then that you just didn't know that you needed?
It's a pretty open question, Jed. Are we talking about like finding those deals, like how to source those deals?
Like how would you power rank the things that are important when you're looking for your first deal that you know now that maybe you didn't know then?
I think having a defined buy box is very important. I think just saying, oh, send me all your deals, you don't differentiate yourself right in the marketplace that you're looking to buy deals. So having a very clearly defined buy box is, I think, the first starting point. It's like buying a red car and all of a sudden you see red cars all over the road. Mm-hmm. By having that, you see what you're looking for more often, and other people know exactly what you're looking for. When a deal comes across their desk in 2 months, they think of you because it was so clearly defined. So understanding what your buy box is, what your buying criteria is. Hey, I want deals in this zip code or this city or this suburb or this whatever. A certain size deal, maybe a certain age of vintage of the deal. I'm defining exactly what I'm looking for. Hey, it's got to be occupied, or I'm looking for land, or I'm willing to develop. I'm looking for something that's occupied with some land with it that I could then further develop. Or I just want something that's fully stabilized at market rate rents that's been built in the past 20 years or newer. Or I'm okay buying something that's maybe 70s or 80s vintage with some value add, and I want to create that equity upside. So like understanding what you want to take on and having full clarity on that then gives other people clarity to then send you those deals.
How do you have that clarity before you've done anything? You know, I think that you figured out the clarity that you want, that your team wants, because you've gone through the paces. But do you think that it's feasible to have that type of clarity when you're first starting out?
Well, I mean, you're not going to go and buy a 100-unit apartment building as an early deal, right? I think having an understanding of, hey, I'm looking to buy 1 to 10 unit deals if I'm starting out. 1 to 10 unit deals in probably my own backyard or within 30 minutes or an hour of where I live is the most that I would go out. And I'm okay with either looking at stuff that's stabilized and looking at stuff that's value add. That's a pretty decent buy box. As you graduate and you get more experience, you're going to realize, hey, I like this suburb, I don't like this suburb. I like this type of product, I don't like this type of product. Maybe you tried a different asset class somewhere in there, you found a mixed-use building with some retail or office on the ground floor and apartments above it. Maybe you like that, maybe you don't like that. Maybe it's harder to finance that, and it's easier to finance if you just stay under 10 units and you want to consolidate and keep on growing under 10 unit buildings. You're gonna experience a lot of that stuff, and your buy box will change as you continue to grow. And as the market changes and financing changes, sometimes you reverse engineer based on what your access to capital is.
I'm sure that you would step out now of your buy box if a deal was so good, so good, or would you?
No, I wouldn't.
Okay.
Not anymore. I used to.
So you would say that even with your experience, you wouldn't. So anyone with less experience probably shouldn't either? Or do you think that there's some wiggle room for your buy box as you're coming along?
There's a lot of great opportunities out there, right? Every opportunity you look at that's not your buy box is a distraction from your buy box. So if you've said, this is my buy box because these are the types of assets that I want, and something comes across your desk that doesn't meet this, it's going to be a distraction from the things that you want. And so depending on how disciplined you are, which I was not as disciplined as I am today earlier on, because I realized, dude, I started going in 12 different states as opposed to just staying in my own backyard. I now only buy in Ohio and the Carolinas because that's where I'm located. That's where my team's located. Not because those are the best markets. I live in Charleston and I split my time
Best markets for
Ohio.
you.
The best markets for me, personally.
you guys had the advantage when you started in multifamily. Your reputation, you had somewhat of a reputation with brokers because you guys were doing single family. What would you say to someone who didn't have that background in single family, who's trying to start in multifamily, in terms of cultivating relationships to find deals with people who know where the deals are?
I think an important part when you're getting started is realizing you're not going to go into 150 unit apartment complexes that are A class in primary cities and compete with hedge funds and family offices and real estate trusts that have been in the market for decades. And even going into secondary cities and competing with guys like me who have portfolios of thousands and thousands of doors probably is unlikely. So if you're earlier on in your journey, I think an important thing to realize is you're going to be buying the stuff that the big guys don't want and the little guys can't qualify for. So there's probably going to be this, 10 units to 50 unit range. It's probably going to be something that needs some value add component to it, meaning it's not going to be fully built out and brand new. It's going to be something along the lines of built in the 70s, needs updates on the mechanicals and the roof and maybe the foundation and maybe the electric, or you got to be okay with that until you get your portfolio to a certain point. I would say about a $10 million portfolio gets you to a point where now, 98% of all deals, not just multifamily deals,
right,
but warehouse, real estate, warehouse, office, retail, you name it, 98% of all real estate deals are under $10 million in the United States. So if you get to a $10 million portfolio, you now, more likely than not, have the experience, have the net worth, and have the liquidity to then be able to go and sponsor loans and take down those 98% of all other deals. So like sprinting to get to that $10 million portfolio, which, depending on the market that you're in, is probably somewhere between 50 to 100 doors if you're in multifamily. Sprinting to get there then puts you on track to be able to then buy and be more selective and change your buy box. But early on, realize you're going to be buying some stuff that you got to get to there because that becomes a stepping stone for all the other things that you're going to end up buying.
Right. This might be not a great question, but I know that circumstances in every deal is different. But how many doors is too many doors for a first deal?
For a first deal?
Yes. If you're doing a first deal, the likelihood that you're going to come out of it on the other side.
I don't know. Would you go and bench 400 pounds by yourself the first deal that you ever took down? No, dude. You're going to go and do something that you feel comfortable and confident doing. So it's going to be something that's probably up to 4 units. Up to 4 units is very easily financeable. You can go get a bank loan from it. You can get hard money loans from it. You probably get a private money loan in order to just fund the whole thing. Hit up Consistent Capital. My boy Witt is the owner of Consistent Capital. He's got all sorts of DSCR loans and all sorts of products if you're looking for stuff under essentially 10 units. So there's much more financing available for something like that, which is going to open up your options there. It's harder to screw that up, right? Because it's a smaller deal. Mm-hmm. It's not going to bankrupt you. If you buy it for $400,000 and you got to turn around and fire sale it, dude, you're not taking on a $400,000 risk. You're taking on probably a $50,000 risk if you have to fire sale it for $350,000. And the reality is it probably is going to maintain its same value. You're just paying the broker fees and you might lose a couple bucks. But like that's the entire risk. As you grow your muscle, like you go to the gym, you grow your muscle in taking down bigger deals. And then you go in for a 20 unit and a 30 unit and a 50 unit and a 75 unit and then a 100 unit.
So the odds that you're going to be successful if your first deal is 30 doors is not very high. The likelihood of success is not as great as if you kind of work your way up to it.
Here's the other thing. I have sponsored loans, which I don't do anymore, but I have sponsored loans for other people, other operators, on a 37-unit apartment building, on a 105-unit apartment building. And they had me holding their hand through that process, right? Unfortunately for the sponsor, I've gotten burned over and over and over again because then they realize they got their equity and then they move on to another deal because now they can qualify for their own deals and they have more equity in that other deal. And when that happens, they neglect this deal. And so I then have to take over the whole thing, take on more of my team's time, and spend more of our money and get less equity than on a deal that we're just doing on our own. but they got a great deal out of it, right? And so if you're newer and you can find somebody who's dumb enough to sponsor loans for you, then absolutely go and lock that in and take down a deal that somebody is your safety net.
Yeah.
This episode of the Legacy Podcast is brought to you by
Legacy Family Mastermind. I know what you're going through. I know you feel stuck in small deals trying to figure out how do you get to that next level. I know it's hard to raise private money for real estate deals the way that the economy's been over the past few years. There are probably properties in your portfolio right now that are either losing money or at best break even, and you're trying to figure out how to turn them into winners. Or you're thinking to yourself, dude, I just want to be able to go on vacation without my business all being on my shoulders. Not having the time freedom or the financial freedom that you thought real estate was going to give you, I see it over and over and over again. But I've got the solution to every single one of those. Legacy Family Mastermind. This is a group of high-level commercial real estate investors that can help you break through every single one of those bottlenecks and help you get to that next level. I mean, you know the saying that when the student is ready, the teacher appears. Here we are. If you are serious about scaling your rental portfolio, we are here for you. This is the group to do it with. We would love to help you on that journey and design the exact life that you want to design so that way you can live it to the fullest. The next step is simple. Just schedule a call with my team at the link below and we'll see if it's a fit, because I want to see you sitting at the table with our Legacy family. Let's go build some wealth together.
Is there a difference, or what principles remain the same in underwriting as opposed from a 5-unit deal to a 100-unit deal? What's the same and what's different?
No, I mean, it's pretty much the same. It's just more of it, right? You're going to do financial due diligence and you do physical due diligence. On the financial due diligence, you go and get copies of all the profit and loss statements from the past several years, tax returns from the past several years. You get all the utility bills, all the vendor contracts. You're going through everything. The tax bill, the insurance you're getting quoted, like I said, utility bills, and then any maintenance contracts and things like that. But you can get a lot of that, even if the seller on a smaller property typically might be using an Excel spreadsheet or not even having any documents or like good financial statements. You'll find better financial statements with the bigger the deal is. But you can always get majority of the information on those smaller deals too, and then pretty much put a pro forma together that's fairly accurate. And then as far as income is concerned, you can get copies of all the different leases, and you can also run comps in the area. Talk to management companies. Hey, what do you think this building would rent for if it was fully renovated? You can look at other rents in the area, go on Rentometer, go on Zillow, and just pull up any sort of other competitor rents and see what those are going for and the condition of those units, the amenities that they have. But you can do all that from a financial due diligence standpoint. And then from a physical due diligence, you're still walking all 5 units on that 5-unit or 50 units on a 50-unit building. You're walking every single one of them and putting a report together on every single one of them on what the condition looks like, what's the flooring, the paint, the fixtures, the mechanicals, the windows, the doors, all that stuff, kitchens, bathrooms. I just have a little sheet on every single different unit. And we mark the unit and we go through it. Now, we don't do that anymore because now we have smart management that does all that as we go through, and it's all consolidated and all in one spot. But that doesn't mean that you couldn't do it if you're newer, starting out, just using a piece of paper that you put together on your own.
From negotiating with the seller, is there a way before you even sit down with the seller to determine whether or not you think they would be interested in seller financing? What are some of the telltale signs that you might be able to seller finance when you're looking to buy a property?
How long they've owned it is a big one, because that's going to dictate what the purchase price was when they bought it and how much they paid down on that. Now, that doesn't mean that they couldn't have refinanced it sooner, but a mortgage is public knowledge. So you can always, if you see something, there's companies that you can go and buy lists from based on these algorithms that they have and these equations that they use on when a property was purchased. They can cross-reference it with the county documents on when mortgages were filed based on the amount of that mortgage and what the rates were at that time and what the typical loan terms were at that time. They understand how much was probably paid down on the mortgage, and they can give you a little bit of a range of what that looks like. So obviously, the longer they've owned it and the more it's paid down, the more equity there is, the more likelihood there is of a seller financing situation. Now, the bigger commercial deals, also commercial loans, are assumable. Majority of them are. The vast majority are assumable, where you can step in, take over that loan, and then maybe there's some sort of element of seller financing in addition to that. My mountain house, I seller financed. My island, I seller financed. My primary beach home, I seller financed. And all of those were, I would say, an older generation, people who were over 60 years old, that had owned the property for a while, that had paid it down or owned it free and clear. They were familiar with the property, they were comfortable with the property, and these are all, $3 million was the smallest purchase price on any of those. And so of all of them, they're financially sophisticated too. And so they were willing to, they understood the value of residual income. They understood the value of, I could put money in a bank account or I could leave it in this hard fixed asset. They understood the value that majority of the front end of these payments is all interest, and principal doesn't get paid out until later. So they're getting they're a little ahead on that.
As it relates to seller financing, you've talked before about blended cost of capital and the idea of keeping that as low as possible reaps bigger returns for you when you go to purchase a property. But if that blended cost is already low enough where you feel like this is going to be a property that you're going to buy, should you still inquire on seller financing, or what's the number there, or is it always just worth asking about?
Well, here's the thing to understand is you got to bring some sort of down payment regardless, right? And so if you're bringing a down payment, unless they're selling it to you for the loan amount, which I doubt that that's the case, but you're gonna have to bring some level of capital to the deal for a down payment. That's gonna be raised from private investors. Your private investors are new to this deal, which means they want probably a minimum of 7% preferred return, probably closer to 8 or 10% preferred return, and they're gonna want equity in the deal. That's typically how a syndication works. The seller is getting their purchase price, right, or their sale price. They're getting exactly what they wanted already, and because of that, they're gonna be a lot more flexible in whatever terms they're seller financing at. So if you can get your seller to be your LP, right, and come back in as the limited partner in this deal and roll back, let's say it's a $10 million deal, and they're gonna roll back in $3 million of their sales proceeds because you're getting a new loan for $7 million and you cash them out on $7 million, they might be willing to roll that $3 million back in at a 4% with 0 equity or 1% equity, where now you have a lower cost of capital by half on the cash flow piece, and you didn't give up any equity in that deal. So absolutely, like that is always my route that I'm gonna take, whether they're willing to roll in all $3 million or even $1 million of it. That put $1 million
matters.
in. Yeah, put $1 million in at 4%, and then raise the other $2 million. It's less money that you have to go and raise, less effort you have to put in, right? And it's at its higher cost of capital versus over here you get a 4% versus an 8%, and you're giving up more equity over here versus less equity over here. So it's absolutely, you just create two classes of investors, one for the seller and then one for these LPs that you're bringing in, and do it that way. So whenever you can bring in seller financing, it's going to be cheaper, it's going to be less equity, it's going to be easier than having to go out and raise money in $100,000 increments.
Yep. Hope you learned a lot here in terms of finding deals and how to negotiate with sellers and everything that goes into that. And we are going to develop maybe a 201 or a 301 conversation here as well, as when it comes to finding deals or how to get from maybe getting your first deal to going from 100 doors to 1,000 doors, and we're going to do that in the future as well. So,
the other thing I would mention is the blended cost of capital. We did a video on that,
Sure.
So we'll link to that in the comments, so that way you can understand exactly how to do the math on it. It's simpler than I think we all make it out to be in our heads, but that's a very important calculation as you start blending out investor money, seller finance money, and your bank loans or traditional financing.
Okay. Tim, thanks so much. If you have any questions based on what we've done here, make sure to drop them in the comments. Make sure to follow, tell a friend, tell an investor that you know, and as always,
Be your best.